Picture this. An offer flashes across your screen. 0% APR for 18 months on balance transfers. Your current cards are bleeding interest. The math looks obvious. Move the debt, skip the interest, pay down principal faster. It feels like tax-free oxygen for your finances. But beneath that glittering headline, there are hidden costs, timing traps, and credit mechanics that can turn a smart move into an expensive mistake. A balance transfer is not magic. It's an engineered financial maneuver that can either shave years off your payoff timeline or quietly make your credit look worse if executed without strategy. The difference between saving thousands and paying more is usually a few minutes of careful planning. We're going to map that plan. What a balance transfer actually is. Clear and simple. A balance transfer moves debt from one card to another, usually to a card with a promotional 0% APR. So interest stops accruing on the transferred balance for a set introductory period. That introductory period, how long you get the 0%, and the transfer fee you pay upfront dictate whether the transfer saves you money. The fee is typically 3% to 5% of the amount transferred. Think of the transfer fee as the ticket price to the interest-free ride. If the interest you avoid over the promo period is larger than the fee, the move can make sense, but only if you actually pay the balance down during the promo and avoid mistakes that void the deal. The promotional window, how long is long enough? Balance transfer promos vary widely. Some cards offer 12 months, others 18 to 21 months, and rare offers stretch longer. The correct promo length is the one that lines up with a realistic payoff plan. If your math shows you'll still have leftover principal when the promo expires, that remaining balance will immediately start accruing the card's regular APR, which can be high. Choose length carefully. More months gives more breathing room, but sometimes a shorter promo plus a lower fee is still the smarter play. The cost math, transfer fee versus interest saved. How to decide? Here's the simple calculation you must do before you press transfer. Calculate the transfer fee. Transfer fee equals balance times transfer fee rate. Estimate interest avoided. Interest saved approximately equals current interest rate times average balance times promo length in years. Compare. If interest saved greater than transfer fee, good candidate. If not, rethink the hidden traps, fees, limits, and penalties. Balance transfers contain several common traps. Transfer fees, 3% to 5%, are added to your balance immediately. This raises your starting balance on the new card. Transfer limits. Issuers may only allow a portion of your existing debt to be transferred, so you might need multiple cards or partial transfers. Late payments can void the 0% promo. Some issuers will cancel the promotional APR if you miss a payment. Then high interest and penalty APRs may be applied. Never miss a payment. New purchases. Putting new purchases on a card with a transferred balance may eliminate the grace period and cause purchases to carry interest immediately while you carry the transferred balance. Treat the new card as a debt repayment tool only while you're on the promo. Each of these can silently erode the expected savings. The smart user anticipates them. How balance transfers affect your credit score. The real mechanics. Balance transfers can affect your score in multiple ways. Hard inquiry. Applying for a new card triggers a hard pull, a small, temporary ding. Average account age. Opening a new card can reduce your average age of accounts, which may slightly lower scores in the short term. Credit utilization. The transfer can lower utilization on old cards, good, but increase utilization on the new card if the new limit is small relative to the transferred balance. The net effect depends on your total available credit across all cards. Keep an eye on utilization in percentage terms, not just balance size. Investopedia and Experian advise keeping utilization under 30%, and ideally under 10 to 20% for best impact. Timing matters when balances are reported and how to game it. One of the best tactical edges comes from understanding when issuers report balances to the bureaus. Some report on the statement close date. Others may report on a different day. If your issuer reports on the statement close date, making a payment before that closing date lowers the balance that gets reported, and therefore lowers utilization. 2 small payments per cycle before the close date can keep reported balances low without changing your month-to-month cash flow. This micro-timing, scheduling payments to manipulate reported balances, is legal, smart, and often overlooked. It's the difference between a transfer that looks bad on paper and one that improves your profile. From theory to operation, we've covered the theory, fees, promo length, score mechanics. Now we convert that into an operational plan you can execute today. This is the playbook that turns a theoretical saving into realized savings. Read it like a heist manual, because precision matters. Step 0. The mindset. Rules you must enforce. Rule 1. The transfer card is a repayment tool. No new purchases until the transferred amount is 0. Rule 2. Auto-pay the minimum immediately. Schedule extra payments to hit your payoff target. Rule 3. Treat the transfer fee as sunk cost. Don't let it justify slower payments. You must attack principal. Rule 4. Monitor reported balances and adjust payments before statement close dates. Timing is power. Keep these 4 rules posted somewhere visible. Step 1. Shop with surgeon-level precision. How to pick the card? When choosing a transfer card, score each candidate on 5 metrics. Promo length, how many months of 0%? Your top priority. Longer gives more time to pay. Transfer fee, 3% to 5% typical. Prefer lower fees but not at the cost of a drastically shorter promo. Transfer limit. Can they accept the full balance you want to move? Reporting behavior and tools. Does the issuer report monthly? And can you schedule payments easily? Post-promo APR. What's the climb if leftover principal remains? Rate each card 1 to 10 on each metric. The highest combined score wins. Step 2. Application sequencing and minimizing score damage. You want the new card, but a new application triggers a hard inquiry and can reduce your average age. Minimize damage. Pre-qualify where possible via soft pull pre-approval tools. These don't ding your score. Apply for only one balance transfer card at a time. Multiple inquiries compound harm. If you're thin-filed, consider a credit union approach or a secured route that still offers promotional transfers. These may have friendlier underwriting and fewer denial risks. If you must apply for multiple cards, cluster them in a tight window only if you're rate shopping for an installment loan. Cards don't benefit much from rate shopping protections. Step 3. Advanced tactics and negotiation. Split large transfers across 2 promos only if each transfer still produces net interest savings after fees. Calculate carefully. Negotiate the transfer fee. Sometimes targeted offers include waived or reduced fees. If you have a relationship with the issuer, ask for a reduced fee. Ask for a pre-approval increase. If you have a decent track record, some issuers will increase limits without a full new application. This can be safer than adding another new account. The day you close the last transfer, picture the moment the final payment posts. There's a quiet satisfaction. Your minimum payments are lower, interest stopped, and your credit utilization has improved in the reports. Balance transfers are powerful tools when used with arithmetic, timing, and discipline. They are brittle when used as wishful thinking. For issuer-by-issuer strategies, fee comparisons, and downloadable payoff calculators that compute whether a specific transfer offer saves money for your balances and interest rates, visit wiseconsultant.com. Wise Consulting Enterprise. We could help you in such. Picture a quiet evening. Your phone pings. Annual fee posting in 7 days. Your first impulse? Close the card and be done with it. But that tiny tap can ripple through your financial life in ways most people never see. On the surface, a card is just plastic. Under the hood, it's a data engine feeding your credit utilization, average age of accounts, credit mix, and your overall risk profile. Close the wrong account and your score can slip. Downgrade the account instead, and you may eliminate the fee while preserving history, limit, and stability. Let's be blunt. Closing a credit card reduces your total available credit. And when available credit drops while balances stay the same, your utilization ratio rises. Utilization is one of the heaviest weighted factors in most scoring models. A jump from 10% to 20% utilization can happen instantly if you remove a large limit from your profile. That's not a theoretical risk, it's mechanical. And lenders price risk. A higher utilization can mean worse loan terms later, even if you never miss a payment. Why do people close cards? Annual fees, duplicate benefits, wallet clutter, or frustration with a card's poor rewards. All valid. But closing is a sledgehammer. A smarter play often exists. Downgrading, also called a product change, to a no annual fee or lower fee version. When done correctly, a downgrade typically preserves the same account number line, keeps the account age intact, keeps the credit line available, and avoids a hard inquiry. It's the surgical move. Lose the fee, keep the history. 2 forces make this decision high stakes. Credit utilization, the percent of your available revolving credit currently in use. Practical guidance. Keep overall and per card utilization below 30% and aim for under 10% for maximum score benefit. If you close a $10,000 limit card while carrying $3,000 across your other cards, your profile can lurch from comfortable to crowded in a single reporting cycle. That shift is visible to lenders on the very next statement close date when balances are reported. Length of credit history, including average age of accounts and the age of your oldest account. Age tells lenders whether you've navigated different market cycles without cracking. Close a veteran 10-year card today, and while its history may remain on your reports for a time, its ongoing contribution to average age will eventually fade. Future, you could be applying for a mortgage and discover your average age dipped right when you needed it stabilized. Here's the picture with numbers, because numbers keep us honest. Scenario A, close. You've got 3 cards. Total limit equals $20,000. Total balances equals $2,000. Utilization equals 10%. You close a card with a $10,000 limit to dodge a fee. New total limit, $10,000. Same $2,000 balance now reports as 20% utilization. You didn't spend $1 more, and yet your perceived risk doubled. Scenario B, downgrade. Same starting point, but instead of closing the $10,000 card, you downgrade it to a no-fee version. You still eliminate the annual fee, but your $20,000 total limit remains. Utilization holds at 10%. Your average age continues to mature. You kept the capacity lender's reward without paying for unused perks. Now, exceptions exist if a card's fee is truly unjustifiable, if benefits are irrelevant, or if the account has recurring negative activity. Closing may be appropriate. Brand new, small limit cards that you never use can sometimes be safely closed with minimal impact, especially if you're not seeking major credit soon. But treat that as last resort, not first move. Before you touch anything, run a pre-decision checklist. Exact credit limit of the card you're targeting. Closing a high-limit card bites hardest. Age of the account, older equals more valuable to your profile. Upcoming big credit events. Home auto loan in the next 6 to 12 months. Defer closures and big changes. Real fee value math. Do perks/credits offset the fee? Downgrade path. Does the issuer offer a no-fee or lower-fee sibling product? Reporting dates. Know when statement close occurs so any balance adjustments reflect on the next bureau report. When you're ready to call the issuer, be clear and precise. Hi, I want to avoid the annual fee, but keep my history and credit line. Can I switch to a no-fee or lower-fee version without opening a new account or triggering a hard inquiry? What options are available? If they say no, pivot, understood. Is there a retention offer, a statement credit or reduced fee? If not, could you confirm how a closure would be reported and whether my account age remains associated with my file? Always document agent names, note the date, and ask for written confirmation via secure message. A few myths to kill. Closing a card deletes it from my history immediately. False. Positive closed accounts often remain for years and can still help age metrics until they eventually fall off. Downgrading always kills my points. Not necessarily. Some issuers let you convert or transfer points before or during a product change. Ask before you act. Product changes require new applications. Often no. Many issuers process downgrades in place with no hard inquiry. Confirm first. Last, keep the big picture in view. This decision isn't just about fees. It's about future pricing on loans, borrowing flexibility, and the story your report tells to underwriters. If you want a structured walkthrough of this decision matrix, how to weigh limit size, account age, and timing, you'll find step-by-step guidance at wiseconsultant.com, including the exact phrasing that consistently gets real options from issuers. Breathe. Don't tap close in a hurry. Downgrade is usually the smarter lever. No fee, no panic, no profile damage, and a cleaner runway for everything that comes next. The tactical playbook. Downgrade like a pro. Close safely when you must and recover fast. Now we flip from why to how, from theory to operations. Think of this as your call sheet, your risk board, your post-move audit. The goal: eliminate waste, fees you don't need, protect score drivers, and stay lender ready. Rule 1. Preserve capacity and age by default. Unless there's a compelling reason, your default should be keep limits alive, keep old lines open, remove the fee. Capacity lowers utilization. Age elevates credibility. Downgrades deliver both. Step 1. Prep in 5 minutes. Gather account number, current limit, open date, fee amount, current balance, and the benefits you actually use. Decide your ask. No fee version with the same line and no hard pull. Step 2. Make the call. Exact language. Start friendly, be specific. I'm reviewing my accounts before the annual fee posts. I'd like to stay with you, but in a product that fits my current needs. Can we do a product change to a no fee or lower fee option while keeping the same account and avoiding a hard inquiry? If the agent hesitates, ask for retention. Could you check if there's a retention credit, points, or a reduced fee that makes staying on the current product worthwhile? If not, the no fee change would be perfect. Confirm everything. Will the limit remain? Any points impact? Will the system note no new account and no hard pull? Request a confirmation message. The right move today shapes the pricing on your next 5 years of borrowing. Downgrading is often the elegant answer. No fee, no new account, no score shock. Just a seamless shift to a product that fits who you are right now. And if you truly must close, doing it clean and documented keeps your profile tight. For scripted phrasing that consistently works with frontline agents, plus a concise call checklist you can keep beside your phone, head to wiseconsultant.com. Use the exact lines above, keep your utilization lean, and let your oldest accounts keep telling the story you've earned. Reliable, seasoned, low risk. Wise Consulting Enterprise. We could help you in such. Picture a neon-lit scene. You, a spreadsheet, and a cascade of welcome bonuses promising free flights, hotel nights, and cashback big enough to feel like a personal windfall. That thrill is the core of credit card churning. Repeatedly opening new cards to capture sign-up bonuses and rewards. It looks like a fast track to luxury. It also looks like a game only the disciplined can win. Because while the upside is real, the downsides are sharp, immediate, and sometimes permanent. The attraction and the hidden risks. Let's be blunt. Churning is deliberately engineering your credit footprint. Every new application creates a hard inquiry and potentially shortens your average account age. Hard inquiries usually dent your score briefly, often fewer than 5 points, and remain on your report for 2 years. They affect FICO scores for approximately 12 months. That small dip can add up if you open several cards in a short window. If you're planning a mortgage or big loan, those points and the timing matter. Why the score moves? Because credit scoring models weigh behavior. Payment history and amounts owed are the heavy hitters. New credit, inquiries, and recent accounts is a measurable chunk too. FICO's public breakdown, the model lenders most often use, shows the categories. Payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, and credit mix, 10%. Opening many new accounts in a compact time window pushes the new credit and length bars in the wrong direction. Churning also bumps up complexity. More accounts mean more payment dates, more minimums, and more chance for a missed payment. And payment history is the single most important factor. If you miss one due date while chasing bonuses, the cost can dwarf any points you earn. The Consumer Financial Protection Bureau has signaled similar concerns around aggressive rewards behavior and the ecosystem that enables it. Programs change, issuers rewrite rules, and consumers sometimes find their expected value suddenly reduced. That regulatory scrutiny matters because it's exactly where churners are most exposed. Then there's issuer behavior. Banks have anti-churning defenses, approval rules, welcome bonus limits, and informal policies that flag repeat applicants. Some issuers restrict reapplying for the same product for months or years. Others limit how many cards they'll issue to a single customer. That means the strategy that worked last year may fail this year. And applying without pre-qualification can pile up hard pulls for no reward. Points Guy and NerdWallet regularly document issuer rule changes and caution that churning carries issuer-specific operational risk as well as credit risk. So, is it worth it? For a small community of highly disciplined travel hackers, yes, they track rules, rotate applications, hit welcome spend thresholds with normal bills, and liquidate rewards reliably. For most people, the strategy is fragile. Churners must be organized, disciplined, and prepared to absorb temporary score movements and sudden program changes. Practical, real-world red flags that show churning is a bad idea for you. You're planning a mortgage, auto loan, or major loan in the next 6 to 12 months. You have limited cash cushion and would struggle to pay unexpected balances. You've had recent credit issues or already have multiple recent hard inquiries. You prefer low cognitive load and don't want to track many due dates and rules. Pre-qualify with soft pulls whenever possible to avoid unnecessary hard inquiries. Space applications. Avoid clustering more than 1 or 2 card applications in a 3 to 6 month window. Use real spending to hit welcome offers. Don't manufacture spending or borrow to hit thresholds. Interest will destroy the math. Document targeted offers, screenshots, email confirmations. The CFPB has warned that reward programs can be devalued if you have to contest a denied bonus. Finally, remember that churning changes your relationship with credit. Instead of one long-term tool you use responsibly, your credit becomes a series of tactical moves. That's fine if you enjoy the game and accept the trade-offs. It's a bad trade if a mistake or a sudden rule change wrecks an application for a home or a critical loan. Next, we will convert this into an operational playbook. Exact pre-qualification scripts, how to time applications, month-by-month checklists for hitting spend thresholds with ordinary bills, how to protect your credit score while churning, and an exit plan if you decide to stop churning and consolidate rewards into real travel or cash. Business expenses that can be deducted and reimbursed. Use these natural categories to meet the required minimum spend rather than artificially inflating purchases. If the bonus requires $50,000 in 3 months, map recurring bills and planned one-off costs, home repair, annual insurance, to meet it without new debt. This preserves ROI and keeps interest risk at zero. How to churn safely if you must. This is the playbook for disciplined churning. Minimize score damage, avoid issuer flags, and protect your creditworthiness. It's not cheerleading, it's defensive strategy. Rule 0. Ask, why are you churning? If the answer is because it's fun, fine. Treat it like a hobby with a budget and don't risk major life credit events. If it's for specific goals, a family trip, a wedding, paid for airfare, document the expected ROI and treat it as a project. Step 1. Pre-qualification and soft checks. Always start with the issuer's pre-qualification tool or a soft pull check. These show likely approvals without producing a hard inquiry. Use them to filter offers and avoid unnecessary hard pulls. Step 2. Calendar your major life events. If you plan to buy a home, lease a car, or apply for major credit, pause churning at least 6 months before the application. Hard inquiries and new accounts complicate underwriting and can reduce your negotiating power. If you're pursuing a mortgage, lenders typically want a stable financial picture for the past 60 to 90 days. Step 3. The one in, one out rule, but smarter. Some churners use one in, one out to limit active accounts. It's a start, but be smarter. Avoid closing old accounts. You preserve age and available credit. Instead, downgrade yearly fee cards to no fee variants when you no longer need benefits. This preserves account age while eliminating fees. Closing accounts is the blunt instrument. Downgrading is the surgical option that protects score drivers. Step 4. Spend plan. Earn without changing lifestyle. Make a list of monthly recurring bills, subscriptions, utilities, groceries, fuel. These are your legitimate spending engines to meet welcome offer thresholds. For example, phone bill, monthly, groceries, and fuel insurance premiums. Step 5. Payment discipline and utilization micro-strategy. 2 tactical rules to protect your score. Pay in full every month. Interest destroys the bonus math. Control reported utilization. Find each card statement close date and make a pre-close payment to lower the balance reported to bureaus. This reduces utilization-related score dips even while you use the card aggressively for bonus spend. Experian and FICO confirm that utilization and reporting dates matter. Timing payments lowers the snapshot balance. Step 6. Application timing and hard inquiry management. Limit hard pulls. Apply only after pre-qualification and only for offers where the net EV, bonus value, minus fees, and any short-term costs is positive. Space applications. A good rule is one major new card every 90 days, though experienced churners may condense this depending on personal risk tolerance. Too many hard inquiries in a short stretch looks risky to scoring models and to lenders. Experian notes. Multiple inquiries will have a larger impact than a single one. Step 7. Issuer rules and records. Keep screenshots of targeted offers, sign-up terms, required spend, and promotion end date. The CFPB has flagged devaluations and unexpected exclusions. If an issuer denies a bonus, your screenshots are proof. Track issuer lifetime rules. Some issuers won't grant a welcome bonus if you've had that card or product in the past 24 to 48 months. Others have one bonus per family or other limits. Track that in your churn spreadsheet. Step 8. Rewards consolidation and exit plan. When you've earned points, convert them to value. Don't let them sit. Transfer to partner programs for travel or redeem for statement credits if that's the plan. Who should churn? Churning is not a beginner hobby. It's for people who have excellent credit and strong payment discipline. Don't need loan approvals soon. Enjoy the tracking and administrative work. Use real spending to hit spend thresholds. For everyone else, a simpler strategy, 1 or 2 rewards cards matched to your biggest spending categories and strict auto-pay in full, will usually produce more net value with far less risk. Want personalized guidance on which cards to use for your bills and how to schedule payments to protect your score? Visit wiseconsultant.com to learn more and get step-by-step coaching. Wise Consulting Enterprise. We could help you in such. Imagine a moment. You stand at a checkout counter or stare at a payment screen. Two options blink back at you, debit or credit. It's a tiny decision, but it ripples. One choice protects today's cash and keeps you out of debt. The other builds a reputation the lending world reads, your credit history, and opens doors to lower interest rates, larger loans, and financial options. Which do you pick and why? What each payment type does, the invisible signals each sends to lenders, and the rules of responsible use that let you harness the advantages of credit while staying firmly out of debt. What debit really is, the cash equivalent. Debit cards draw money directly from your checking account. When you swipe or tap, funds leave your balance. The instant clarity is powerful. You can't spend what you don't have unless an overdraft program kicks in. For people who struggle with impulse spending, debit is a blunt instrument of discipline. Practical, concrete reasons to prefer debit in certain moments. No interest charges, because there is no borrowed money. Immediate visibility. Your bank balance reflects purchases in real time, making budgeting simpler. Lower temptation. Psychologically, you're more likely to limit discretionary purchases when you see your balance drop. Good for small, everyday purchases where rewards and dispute protections are less critical. But debit has trade-offs you must understand. It usually does not build credit. Debit card activity isn't reported to the major credit bureaus as on-time payments, so it won't improve your credit score. Fraud and recovery can be slower. Because debit pulls from your cash, unauthorized transactions temporarily reduce your available funds. While many banks offer fraud protections, the process to recover cash can take longer than credit card dispute processes. During that recovery window, you may face bounced checks or lost purchasing power, overdraft fees, and limited consumer protections in some cases. If you aren't careful, small mistakes become expensive. Use debit when you want tight control, when the purchase is small and routine, or when you absolutely cannot carry credit balances without falling into debt. What credit really is: borrowing with signals. A credit card is a promise. The issuer pays now, you repay later. That borrowed money creates two powerful systems: a borrowing mechanism. If you carry balances, you pay interest. A credit reporting mechanism. The issuer reports your payment history, balances, and account age to credit bureaus. This reporting builds your credit profile, the story lenders read when you apply for a loan. Why credit matters beyond rewards. Payment history is the single largest scoring factor. Consistent, on-time payments build trust and increase your score over time. Credit utilization, the share of revolving credit you're using, is a major lever. Keeping utilization below 10 to 30% of available credit is a widely recommended target to maximize scoring impact. Account age and credit mix also matter. Responsibly used credit creates a mixed, mature profile lenders like. Credit gives you legal protections and conveniences that debit often does not. Purchase disputes and chargebacks. With credit, you can dispute a merchant and withhold payment during the dispute process, protecting both cash flow and consumer rights. Fraud protections. Many issuers offer zero liability policies for unauthorized charges and remove disputed amounts quickly from your balance while they investigate. Rewards, purchase protection, and extended warranties. These benefits can effectively lower your net cost on purchases and deliver value debit won't provide. But credit brings the risk of interest and long-term cost if misused. A single unpaid month can generate interest that outstrips any rewards you earned. That's why the card use rules matter. The golden rules of credit use to avoid debt. If you're going to use credit, do it like a professional. Here's the ironclad playbook. Always aim to pay in full each month. Interest is the enemy of any reward or convenience. If you never pay interest, you harness credit's benefits without debt's cost. Keep utilization low. That means keeping balances under 10 to 30% of your total available credit on reporting dates. Less than 10% is ideal for aggressive score gains. Use one primary rewards card and one backup. Simplify your payments to reduce missed payments. Schedule autopay for at least the minimum. Plan to pay the full balance. Autopay is the safety net that prevents accidental interest. Avoid cash advances and convenience checks. They often carry immediate fees and higher APRs. When used this way, credit becomes a tool. It builds your reputation without adding cost. When debit wins, practical scenarios. Use debit when you're paying for groceries, coffee, or low-value daily expenses, and you want to avoid temptation. You're on a tight budget, and any borrowed money would be risky. You need instant balance visibility to prevent bounced payments or overdraft fees. You're making ATM withdrawals. Debit is the natural choice. When credit wins, practical scenarios. Use credit when you're shopping online or using a merchant you haven't used before. The dispute and fraud protections offer a safety net. You want purchase protection, loss/damage, or extended warranties. Credit cards often extend manufacturer warranties or cover losses. You're earning rewards on planned spending, you'll pay off anyway. You need short-term float between purchase and payday, but only if you can absolutely pay the balance in full. The hybrid strategy. Best of both worlds. You don't have to pick one lane forever. Many successful money managers use a hybrid approach. Primary budget on debit. Day-to-day small purchases live on debit for discipline. Planned purchases on credit. Bills, large purchases, travel, and online shopping go on credit to capture protections and rewards. A credit-building plan? Use one low-limit card for recurring subscriptions or a small, manageable monthly charge and pay it in full. This builds payment history without risk. Emergency reserve. Keep a credit card reserved for true emergencies only and replenish your savings to avoid using it. This blending keeps you debt-averse while harvesting credit's structural benefits. Real-world psychology. Why people slip. Understanding behavior is crucial. Credit temptation is real. A high limit feels like extra cash. The antidote is designing friction. Use debit for impulse purchases and require a short waiting period before using credit for discretionary items. Set rules. No credit for clothes until 48-hour consideration. These rules reduce regret spending. How credit builds. Over time, and why it's worth the effort. Credit is not magic, it's a record. The major components you directly control are payment history. Make payments on time. That single habit produces the most scoring lift over time. Amounts owed, utilization. Low balances relative to limits produce measurable score gains. Length of credit history. Older accounts help. Keep fee-free accounts open where practical. Credit mix. A healthy combination of revolving accounts and installment loans helps, but only if responsibly managed. New credit inquiries. Minimize these around important loan events. Concrete tactics to build credit without debt. Set a recurring small charge on a single card, a subscription, or a small utility, and pay it in full. This creates a reliable reporting item. Consistent, documented on-time payments. Use a secured card if you have no history. Deposit cash as collateral, use the card for small charges, and pay in full. Many secured cards report to bureaus and graduate to unsecured if you show responsible use. Become an authorized user on a trusted person's account with a long, clean history. You can inherit age and positive history. Use this ethically and only with people you trust. Ask for small credit line increases after months of perfect payments. More available credit lowers utilization without new accounts. Practical playbook. Use debit for impulse spending to enforce discipline. If you need to build credit from zero, use a secured card or become an authorized user. WiseConsultant.com helps clients understand how to apply these rules to their unique situations, which card to use when, and how to build credit while staying debt-free. If you want confident decision-making, follow the playbook above. Keep the discipline, and let small, consistent actions rewrite your financial future. If you liked this guide, subscribe to the channel for weekly tactical lessons on credit and personal finance. Use the rules you learned tonight. Pick your payment option with intention, not habit, and watch your financial options grow. Wise Consulting Enterprise. We could help you in such. Picture this. You're backstage before the biggest audition of your life. You don't need a new song. You need the right mic. In the world of credit, a credit line increase is that mic. A small, strategic change that amplifies your financial voice. It can lower your credit utilization, unlock better loan pricing, and open doors to higher limits and better offers. But ask carelessly, and you'll drop the mic. Hard inquiries, mistimed requests, and ill-managed limits can nudge your score in the wrong direction. This isn't negotiation theater. It's timing, evidence, and language. And yes, you can do it without hurting yourself. This first part maps when to ask, the signals lenders watch for, and the mental checklist you must complete before you hit the phone or the app. Why a credit increase matters. The mechanic. A credit line increase is one of the most underused levers in personal finance. It affects three major things. Credit utilization. Raising your available credit lowers utilization, balance divided by limit, which often boosts your score quickly. A bump from $5,000 to $10,000 can cut your utilization in half overnight. Loan pricing and offers. Lower utilization and a stronger profile improve your odds for better interest rates on loans. Lenders see lower risk and price accordingly. Flexibility and emergencies. More credit gives breathing room. But remember, Flexibility is powerful only if you don't confuse it with spending power. But a limit increase is not always a free lunch. Issuers sometimes perform a hard inquiry that temporarily dents your score. Others do a soft pull that leaves your score untouched. The art is to ask in a way that avoids an unnecessary hard pull. The ideal candidates. When you're ready to ask, don't ask because you feel entitled. Ask because your profile has changed in ways lenders value. Ask when you've had 6 to 12 months of on-time payments on the account. Payment history is the heaviest signal. Your income has increased, raise, new job, bonus, and you can document it. Lenders prefer higher income relative to balances. Your utilization is low, ideally under 10 to 20%, and steady on reporting days. Low utilization signals responsible behavior. You haven't had recent hard inquiries. 6 months is a safe buffer. Multiple recent applications look like risk-seeking. You've resolved recent derogatory marks, collections paid, disputes cleared, and your report is clean. Lenders hate surprises. If you meet at least a few of these, you're in a strong position. The Before You Ask checklist. Do this first. Before you ask for more credit, complete this micro-audit. Pull your latest credit reports, Equifax, Experian, TransUnion, and confirm account data is accurate. Calculate your current utilization across all cards and on each card statement close date. Document income changes, pay stubs, offer letters, or official company emails. List payments. History. 6 to 12 months of on-time payments on the requesting account is golden. Confirm the issuer's policy. Some banks automatically review and grant increases. Others require a manual request. Check their FAQ or call support for reporting practices. This homework transforms your ask from a request into a fact-based proposition. Soft pull versus hard pull. The difference that changes everything. Here's the strategic center. Ask for a soft pull-only review. Many issuers will perform a soft check to evaluate an increase. No score impact. But some will automatically run a hard pull unless you explicitly say otherwise. If the agent says a hard pull is required, pause. You can either accept the hard pull, if your profile is otherwise clean and the potential benefit outweighs the temporary ding, or you can ask for reconsideration later after building more positive signals. What to expect after you ask. If approved, soft or hard pull. New limit posts in 1 to 5 business days. Check your online account and your credit reports the next reporting cycle to confirm the change and the reporting behavior. If denied, common, ask for a reconsideration reason. Many issuers will give a specific factor, income, utilization, age of account. You can then address it and reapply later. If they require a hard pull, weigh the short-term score dip versus long-term benefit. If your utilization will drop enough to offset the hard pull, the net score may improve in a few months. The responsible use rules. If you get the increase. New credit is not an invitation to spend. Treat your new limit as a rescue lane, not a runway. Keep utilization low. Aim for less than 10 to 20% on reporting dates. Avoid large one-off purchases that you can't pay off quickly. Consider a small auto transfer to sweep balances to a savings or payoff plan. Don't let the old habit continue. Recalculate your emergency fund. Extra available credit is not a substitute for cash. When to re-ask after denial. Exact timelines. A denial is feedback, not a wall. Common waiting windows. Soft denial for lack of income or recent history. Wait 3 to 6 months after improving income or establishing 6 more months of on-time payments. Denial due to recent inquiries. Wait 6 to 12 months. Hard inquiries fade and their effect diminishes. Denial for utilization. Lower balances and wait 1 to 2 billing cycles, then reapply. A quick drop in utilization is sometimes enough. Denial for account age or limited history. This needs time, often 6 to 12 months of steady behavior. If the issuer gives a reason, follow it precisely. If they don't, ask for the specific reason code or a clear explanation. It gives you targets to change. Alternative paths to more credit without a hard pull. If the issuer insists on a hard pull, try these alternatives. Request an unsecured product upgrade within the issuer. Sometimes they can convert your product internally with a soft review. Ask for a small temporary increase. Some banks offer short-term boosts that require less underwriting. Become an authorized user on a trusted person's account with long history. This can raise your available credit indirectly without an inquiry. Use ethically and with trust. Apply for a targeted pre-approved offer. Soft pull first. These are often issuer-specific and come with higher approval odds. Responsible aftercare. What to do after approval. Update your utilization targets and set new autopay levels if necessary. Avoid using newfound room to increase habits. Instead, schedule a monthly review. Consider incremental increases. Ask again for a modest bump after 6 to 12 months of responsible use. Frequent small increases are often safer than a single giant leap. Document everything. Save approval emails, new limit screenshots, and confirm via credit reports that the new limit is properly reported. Common pitfalls. What to avoid at all costs. Treating increased credit as spending money. That instantly negates the benefit. Rushing into hard pull requests without asking for soft reviews first. Applying for multiple increases or cards at once. Each hard pull stacks damage. Closing the old account after a limit increase elsewhere. Account age matters. Don't sabotage your history. The ask as a strategic move. Asking for a credit increase is an exercise in timing, evidence, and restraint. When you prepare the facts, income proof, utilization math, and a solid history, and you ask with the exact language that preserves a soft pull, you convert a small request into a big advantage. The reward is not just a higher limit. It's an improved financial posture that yields better offers, lower rates, and quieter peace of mind. If you want the exact scripts formatted for phone, chat, and secure message, plus a one-page checklist to print and follow before every request, visit wiseconsultant.com. Start small, ask smart, and let the compound effect do the rest. Wise Consulting Enterprise. We could help you in such. Picture yourself in a high-stakes heist movie. The vault isn't gold, it's your future purchasing power. The tools you pick will either open doors or set off alarms. In the world of personal finance, credit cards are those tools. But here's the truth that most people miss. Not all cards are created equal. Some are polished keys that unlock stronger credit. Others are rusty locks that quietly drag your score down. If you want to build credit, you need a card that behaves like an ally, one that reports responsibly, gives you room to maneuver, and rewards the right behavior. This is not about chasing points or flashy perks. It's about picking instruments that teach the scoring models to favor you. At wiseconsultant.com, we guide clients away from traps and toward cards that actually move the needle. Ready? Let's map the battlefield. Why the choice matters. Signals over superficial perks. Your credit score is a messaging system. It listens for signals. Payment history, credit utilization, account age, credit mix, and recent inquiries. A card's fine print determines what signals you send. A card that reports to all 3 major bureaus, for example, broadcasts your good behavior. A card that doesn't report widely might be pretty but invisible. So before you fall for a glossy rewards pitch, ask, will this card help my credit story or simply decorate my wallet? The core categories. Which card types actually build credit? Let's cut through noise and name the categories that matter when you're building or repairing credit. Each has strengths and trade-offs. Secured credit cards. What they are. You deposit cash as collateral and get a credit line roughly equal to your deposit. Why they work. They almost always report to bureaus and are designed for those with limited or damaged credit. Key win. Low risk to issuers equals higher approval odds and a straightforward path to show on-time payments. Watch for high fees and poor upgrade terms. Choose secured cards that graduate to unsecured accounts and refund your deposit. Starter/student cards. What they are. Unsecured cards for people with little or no credit history. Why they work. They report activity and often come with lower credit limits that make it easier to keep utilization low. Key win. Designed to teach good credit behavior early. Watch for high APRs and weak rewards. Don't chase cashback if it means missing the core purpose. Building history. Credit builder cards and loans. What they are. Products explicitly marketed to build credit. Sometimes a tiny credit builder loan that reports payments. Why they work. They're structured to create a consistent payment history and are often accepted by folks with thin files. Key win. Discipline focused. You pay, they report, you build. Store/retail cards. What they are. Co-branded lines with retailers. Why they can help. They're easier to get and can add credit mix. Watch for Typically high APRs and narrow usefulness. Only use for planned purchases and pay in full. Authorized user routes. What it is. Being added to a responsible person's mature account. Why it works. You can inherit positive history and available credit. Fast. Watch for. It must be a trusted partnership. Any negative activity impacts you too. The 9 features you must hunt for and why. When scanning offers, treat each card like a dossier. These are the non-negotiable features that actually help your score. 1. Reports to all major bureaus. If the card doesn't report to at least 2 major bureaus, Equifax, Experian, TransUnion, its power to build credit is limited. Ask the issuer directly and prefer cards that explicitly confirm bureau reporting. 2. Reasonable fees or no annual fee. A card that drains you with fees undermines the whole purpose. Avoid high annual fees unless the card offers a clear, measurable path to a stronger credit profile that justifies the cost. 3. Clear upgrade path. Good issuers allow you to graduate from secured to unsecured or increase your limit after consistent responsible use. This path increases available credit and account age, both beneficial. 4. Transparent terms, grace period, and APR. Understand the grace period, days you have to pay before interest starts, and the APR. When building credit, paying in full avoids interest traps, but a predictable, reasonable APR protects you if you ever slip. 5. Tools for control, alerts and autopay. Choose cards with payment reminders, auto-pay options, and easy online management. These tools reduce human error and keep your payment history spotless. 6. Modest but meaningful credit limit. A tiny limit is fine. What matters is the ability to keep utilization low. A card that gives $300 but you never push it past 10% is more powerful than a $5,000 limit you constantly flirt with. 7. Reporting of full range, not just balances. The best cards report on payment history and balance, not just one or the other. Multiple data points strengthen the narrative lenders read. 8. Upgrade and reconsideration policies. Look for issuers with flexible reconsideration, hardship, and upgrade policies. These paths help you evolve your relationship with credit as your financial picture improves. 9. Educational resources and credit tools. Some issuers provide free credit score tracking, coaching content, or simulations showing how behavior affects scores. These resources make your progress visible and strategic. How issuers differ. The fine print that changes everything. 2 cards may look identical on paper, but issuer behavior matters. One issuer might report balances mid-cycle, another reports on the statement date. One might automatically increase limits after months of good use. Another requires manual review. These operational details determine whether your micro-strategies, like mid-cycle payments, actually lower the reported balance. That's why at wiseconsultant.com we teach people to read issuer patterns, not just marketing copy. The same payment behavior can produce different reported outcomes depending on when and how the issuer reports. The tactical shortlist. Which card archetypes to seek now? You've learned the battlefield. Now it's time to choose the weapon. Not a single best card exists for everyone, but there are clear archetypes that repeatedly win for people who want to build or repair credit. Here are the ones to hunt for, how to use them, and the exact behaviors that turn them into score-building machines. Secured cards with graduation paths. Pick a secured card that explicitly reports to all 3 bureaus and promises a clear upgrade to unsecured status after a period of good behavior. The deposit is your collateral. The reward is a converted account with positive payment history and an improving credit age. Use it for planned, small purchases, pay in full, and watch the issuer move you to the next level. Credit Builder loans/hybrid products. These are financial training wheels. You borrow a small sum that sits in a locked account while you make scheduled payments. Each on-time payment becomes a documented credit win. If you're thin-filed, this consistent payment history is gold. Starter/student cards with tools. Choose starter cards that offer strong account controls, auto-pay, alerts, easy limit management. Even modest limits help if you keep utilization low and payment history clean. Prioritize tools that prevent mistakes. They matter more than a few percentage points of rewards. Practical promise. Here's the unavoidable truth. Cards won't fix everything overnight, but the right card, used the right way, is a multiplier. If you treat the product like a tool, not a toy, you can write a better credit story faster than most realize. Start with one solid account. Use it responsibly. Learn your issuer's reporting timing. Automate, audit, and request upgrades when deserved. If you want a tailored map, which card archetypes fit your exact file, which issuers report when and how to time payments for maximum effect, wiseconsultant.com has the framework frameworks and client playbooks to guide you. Subscribe to the channel, follow the step-by-step playbooks, and let the small, disciplined acts compound into real financial power. Remember, credit is not luck, it's behavior. Make your next swipe a strategic move. Subscribe to the channel for weekly tactical guides that turn confusing credit mechanics into simple, repeatable rituals. Wise Consulting Enterprise. We could help you in such. Picture this. An offer flashes across your screen. 0% APR for 18 months on balance transfers. Your current cards are bleeding interest. The math looks obvious. Move the debt, skip the interest, pay down principal faster. It feels like tax-free oxygen for your finances. But beneath that glittering headline, there are hidden costs, timing traps, and credit mechanics that can turn a smart move into an expensive mistake. A balance transfer is not magic. It's an engineered financial maneuver that can either shave years off your payoff timeline or quietly make your credit look worse if executed without strategy. The difference between saving thousands and paying more is usually a few minutes of careful planning. We're going to map that plan. What a balance transfer actually is. Clear and simple. A balance transfer moves debt from one card to another, usually to a card with a promotional 0% APR. So interest stops accruing on the transferred balance for a set introductory period. That introductory period, how long you get the 0%, and the transfer fee you pay upfront dictate whether the transfer saves you money. The fee is typically 3% to 5% of the amount transferred. Think of the transfer fee as the ticket price to the interest-free ride. If the interest you avoid over the promo period is larger than the fee, the move can make sense, but only if you actually pay the balance down during the promo and avoid mistakes that void the deal. The promotional window, how long is long enough? Balance transfer promos vary widely. Some cards offer 12 months, others 18 to 21 months, and rare offers stretch longer. The correct promo length is the one that lines up with a realistic payoff plan. If your math shows you'll still have leftover principal when the promo expires, that remaining balance will immediately start accruing the card's regular APR, which can be high. Choose length carefully. More months gives more breathing room, but sometimes a shorter promo plus a lower fee is still the smarter play. The cost math, transfer fee versus interest saved. How to decide? Here's the simple calculation you must do before you press transfer. Calculate the transfer fee. Transfer fee equals balance times transfer fee rate. Estimate interest avoided. Interest saved approximately equals current interest rate times average balance times promo length in years. Compare. If interest saved greater than transfer fee, good candidate. If not, rethink the hidden traps, fees, limits, and penalties. Balance transfers contain several common traps. Transfer fees, 3% to 5%, are added to your balance immediately. This raises your starting balance on the new card. Transfer limits. Issuers may only allow a portion of your existing debt to be transferred, so you might need multiple cards or partial transfers. Late payments can void the 0% promo. Some issuers will cancel the promotional APR if you miss a payment. Then high interest and penalty APRs may be applied. Never miss a payment. New purchases. Putting new purchases on a card with a transferred balance may eliminate the grace period and cause purchases to carry interest immediately while you carry the transferred balance. Treat the new card as a debt repayment tool only while you're on the promo. Each of these can silently erode the expected savings. The smart user anticipates them. How balance transfers affect your credit score. The real mechanics. Balance transfers can affect your score in multiple ways. Hard inquiry. Applying for a new card triggers a hard pull, a small, temporary ding. Average account age. Opening a new card can reduce your average age of accounts, which may slightly lower scores in the short term. Credit utilization. The transfer can lower utilization on old cards, good, but increase utilization on the new card if the new limit is small relative to the transferred balance. The net effect depends on your total available credit across all cards. Keep an eye on utilization in percentage terms, not just balance size. Investopedia and Experian advise keeping utilization under 30%, and ideally under 10 to 20% for best impact. Timing matters when balances are reported and how to game it. One of the best tactical edges comes from understanding when issuers report balances to the bureaus. Some report on the statement close date. Others may report on a different day. If your issuer reports on the statement close date, Making a payment before that closing date lowers the balance that gets reported, and therefore lowers utilization. 2 small payments per cycle before the close date can keep reported balances low without changing your month-to-month cash flow. This micro-timing, scheduling payments to manipulate reported balances, is legal, smart, and often overlooked. It's the difference between a transfer that looks bad on paper and one that improves your profile. From theory to operation, we've covered the theory, fees, promo length, score mechanics. Now we convert that into an operational plan you can execute today. This is the playbook that turns a theoretical saving into realized savings. Read it like a heist manual, because precision matters. Step 0. The mindset. Rules you must enforce. Rule 1. The transfer card is a repayment tool. No new purchases until the transferred amount is 0. Rule 2. Auto-pay the minimum immediately. Schedule extra payments to hit your payoff target. Rule 3. Treat the transfer fee as sunk cost. Don't let it justify slower payments. You must attack principal. Rule 4. Monitor reported balances and adjust payments before statement close dates. Timing is power. Keep these 4 rules posted somewhere visible. Step 1. Shop with surgeon-level precision. How to pick the card? When choosing a transfer card, score each candidate on 5 metrics. Promo length, how many months of 0%? Your top priority. Longer gives more time to pay. Transfer fee, 3% to 5% typical. Prefer lower fees but not at the cost of a drastically shorter promo. Transfer limit. Can they accept the full balance you want to move? Reporting behavior and tools. Does the issuer report monthly? And can you schedule payments easily? Post-promo APR. What's the climb if leftover principal remains? Rate each card 1 to 10 on each metric. The highest combined score wins. Step 2. Application sequencing and minimizing score damage. You want the new card, but a new application triggers a hard inquiry and can reduce your average age. Minimize damage. Pre-qualify where possible via soft pull pre-approval tools. These don't ding your score. Apply for only 1 balance transfer card at a time. Multiple inquiries compound harm. If you're thin-filed, consider a credit union approach or a secured route that still offers promotional transfers. These may have friendlier underwriting and fewer denial risks. If you must apply for multiple cards, cluster them in a tight window only if you're rate shopping for an installment loan. Cards don't benefit much from rate shopping protections. Step 3. Advanced tactics and negotiation. Split large transfers across 2 promos only if each transfer still produces net interest savings after fees. Calculate carefully. Negotiate the transfer fee. Sometimes targeted offers include waived or reduced fees. If you have a relationship with the issuer, ask for a reduced fee. Ask for a pre-approval increase. If you have a decent track record, some issuers will increase limits without a full new application. This can be safer than adding another new account. The day you close the last transfer, picture the moment the final payment posts. There's a quiet satisfaction. Your minimum payments are lower, interest stopped, and your credit utilization has improved in the reports. Balance transfers are powerful tools when used with arithmetic, timing, and discipline. They are brittle when used as wishful thinking. For issuer-by-issuer strategies, fee comparisons, and downloadable payoff calculators that compute whether a specific transfer offer saves money for your balances and interest rates, visit wiseconsultant.com. Wise Consulting Enterprise. We could help you in such. You open a bill and your heart drops. A surprise medical charge, an ER visit, a billing error, or an insurance denial. You pay what you can, and then weeks later you discover a collection account on your credit report. Suddenly your mortgage rate jumps, your rental application is flagged, and job prospects shrink. This is the hidden fallout of medical bills. Quiet, unfair, and terrifyingly common. Today, we expose how medical debt sneaks into your credit file, why recent policy shifts matter, and the exact steps you can take to fight back and reclaim your financial life. The scope of the problem and why it hurts. Let's start with how widespread this is. Medical debt is not niche. It touches millions. Recent research shows a very large share of U.S. households carry medical bills, with a sizable fraction past due or being paid over time. Medical debt is one of the leading sources of debt that ends up in collections and on credit reports. Why medical debt is different from other debt. Medical bills are unique because they often result from accidents or emergencies, events outside normal budgeting. They're unpredictable, sometimes billed incorrectly, and often disputed with insurers. Unlike a credit card you chose to open, medical debt can reflect miscommunication, coverage gaps, or billing errors. Yet the credit bureaus historically treated a medical collection like any other unpaid bill, a black mark that drags down your credit score, sometimes for years. The policy backdrop: big changes, rapid shifts. Because medical debt wreaks such wide harm, the credit industry and regulators have started to change how it's handled. In 2023, the three major credit bureaus removed medical collection debts under $500 from consumer credit reports, a huge move that erased small balances for millions of people. That change alone produced meaningful score improvements for many consumers. Then, in January 2025, the Consumer Financial Protection Bureau, CFPB, finalized a broader rule aimed at keeping medical bills out of credit reports used by lenders, an action that would have removed an estimated tens of billions of dollars in medical collections from reports. That rule was poised to dramatically reduce medical debt-related damage for millions. But legal challenges and court actions soon followed. A later federal decision blocked full implementation, leaving the legal landscape in flux. The takeaway: progress has been made, but uncertainty remains. So you can't just sit and wait for the system to fix it for you. How medical collections dent your score in life. A medical collection on your file can do more than subtract points. It can raise mortgage and auto loan rates, increase insurance premiums, sabotage rental and employment checks, and reduce access to premium credit products. In some documented analyses, removing medical collections led to average increases of about 20 points on credit scores for affected consumers, enough to move people into higher approval tiers or better rates. That's real money. 3 hidden ways medical debt creeps into your credit file. Billing errors and coding mistakes. Hospitals and providers use complex codes. Billing errors are common and can land you in collections mistakenly. Insurance denials and gaps. A valid claim can be denied, leaving the patient on the hook while they fight the insurer. Aggressive provider/collector practices. Some providers send accounts to collections quickly or report them inconsistently, sometimes without adequate validation. Because these are not always straightforward debts, disputes often succeed if you act with evidence and speed. The timeline you must understand. Most collection accounts, medical or otherwise, can remain on your credit report for up to 7 years from the date of first delinquency under the Fair Credit Reporting Act, FCRA. That's a long shadow. Even if a debt is old or partially paid, it can still show up unless the bureau removes or the creditor updates it. However, because bureaus voluntarily changed policy for small balances in 2023, many low-dollar medical collections are already gone, but larger medical debts still have teeth. Here's the uncomfortable truth. Waiting will almost always cost you more. Interest, insurance rate hikes, denied loans, and lost job opportunities compound the original medical charge. But there's good news. Medical debt is one of the most winnable problems on your report if you take the right steps. Below, I'll give you the tactical playbook. But first, understand the leverage you have. Billing is complex, insurers make mistakes, and collectors must validate debts. Use that leverage. Immediate checklist. Do this right now. Pull your 3 credit reports and look specifically for medical collections: Experian, Equifax, TransUnion. Gather your bills, EOBS, explanation of benefits, and insurance communication. These are your evidence. Don't pay a collector until you get validation in writing. Paying without a written agreement might not remove the negative mark. Contact your provider's billing office to request an itemized bill and ask for charity financial assistance if you qualify. Act now. Medical debt may be reversible, but only if you treat it like the urgent medical emergency it is to your credit. 1. Triage the account. Move fast, get docs. First rule: don't pay a collector until you've validated the debt. Ask for an itemized bill, your explanation of benefits, EOB from the insurer, and any communication showing the date of first delinquency. Hospitals and insurers make mistakes. Billing codes, duplicate charges, or misapplied insurance payments are common. You need paper. Request everything in writing and save it. 2. Check insurance and appeal denials. If the amount looks like it should have been covered, submit an insurance appeal. Insurers sometimes deny claims for coding reasons or missing pre-authorization. The appeals process can reverse responsibility back to the insurer and stop collection activity. Use the insurer's appeal contact information on your EOB and keep every reply. Don't let a denial stand without a documented appeal. 3. Apply for hospital financial assistance/charity care. Most nonprofit hospitals have financial assistance programs and extended deadlines. Some policies give you 240 days to apply from the first bill. If you qualify, your balance can be reduced or forgiven, and the collection can be avoided or removed. Ask for the hospital's FAP, financial assistance policy, and apply immediately. 4. Dispute errors with the credit bureau's FCRA rights. Under the Fair Credit Reporting Act, FCRA, You can dispute inaccurate medical collections with Experian, Equifax, and TransUnion. File a dispute online and by certified mail with copies of your EOBS, itemized bill, and any insurer correspondence. Make the case that the trade line is inaccurate or unverified. The bureaus have 30 days to investigate. If they can't verify, the item must be removed. 5. Validate with the collector. Debt validation, line FDCPA. Collectors must validate the debt and prove you owe it. Send a written debt validation request under the Fair Debt Collection Practices Act FDCPA. Demand account specifics, dates, original creditor, and chain of custody. If they can't legally validate, they must stop collection and should withdraw reporting to the bureaus. 6. Negotiate. Be prepared to settle, but get it in writing. If the debt is valid and you can pay, negotiate. Ask for a reduction, a payment plan, or a pay-for-delete agreement. Pay-for-delete is not guaranteed and not supported by bureaus, but some collectors will agree in writing to remove the trade line upon receipt of payment. Never pay without a signed agreement that explicitly states the collector will delete or update the account across all 3 bureaus upon receipt. Negotiation script. Phone plus follow-up email. I can pay X dollars today if you will provide a written agreement that you will delete this account from all 3 credit bureaus upon clearing the payment. Please confirm in writing. If this feels overwhelming, you don't have to go it alone. Wise Consultant specializes in medical debt removal audits, formal disputes, and lender-ready rapid rescoring packs. Visit wiseconsultant.com to download our medical debt survival kit, letters, scripts, and a 90-day action calendar you can use immediately. Book a strategy call and we'll build a bespoke removal plan that lenders will accept. Subscribe to the channel for weekly battle-tested credit strategies and hit like if you learned one new tactic. Medical bills don't have to haunt you. Fight back, document hard, and reclaim your financial future with Wise Consultant at your side. Wise Consulting Enterprise. We could help you in such.